Trump just nominated Kevin Warsh to be the Fed chair. In this video, I'm going to break down what that means, why Trump nominated him, and what that could mean for the housing market. Mortgage rates are finally starting to come down. After years of rate hikes, after years of higher for longer, and after years of watching housing freeze in place, something is changing. And yet housing still feels completely broken. Prices won't fall, buyers still can't afford homes, and millions of homeowners still feel trapped, not because they love their house, but because they love their mortgage. So now Donald Trump wants to change one thing: the Federal Reserve. He wants Kevin Warsh to be in charge. And the goal is simple. He wants lower interest rates. Now, on paper, that sounds like a fix. Lower rates mean cheaper mortgages. Cheaper mortgages mean more buyers, and more buyers should mean a healthier housing market. Except that's not how housing actually works, because housing doesn't break or recover the way people think it does. And today I'm going to explain how Trump's Fed pick could unlock housing or make it worse. Trump has been very clear about one thing. He believes interest rates are too high, and he blames Jerome Powell, the current Fed chair. Trump has wanted to get rid of Jerome Powell in any way possible ever since he took office again, and he blames him primarily for the housing affordability crisis. He's criticized the Fed before. He's criticized Jerome directly, and now he wants a Fed chair who is more willing to cut rates. That's why Kevin matters. Warsh is seen as more open to easing monetary policy sooner, especially if economic growth slows. And Trump's belief is straightforward. Lower rates help growth, lower rates help affordability, and lower rates help housing. But here's the detail that most people miss. The Fed doesn't control mortgage rates directly. And this is where the conversation starts to go wrong with housing. Mortgage rates are driven mostly by long-term bond yields, not the overnight Fed rate. And bond yields depend on trust. Trust that inflation is under control. Trust that the Fed isn't being pressured politically. Trust that future rate cuts won't backfire. So here's the paradox. If markets believe a Warsh-led Fed cuts rates responsibly, mortgage rates can go lower. But if the market believes the Fed is cutting too fast or under political pressure, bond yields will rise. And when bond yields rise, mortgage rates stay high or even increase. And that's how you get the weird outcome where the Fed cuts rates and mortgages don't get cheaper. But let's assume the optimistic scenario happens. Mortgage rates fall, not to 3%, not back to pandemic lows, but enough to bring buyers back. Here's what actually happens next. Demand will increase. Buyers who were waiting to jump in, investors rerun the math, and homeowners with low rates stay put. But supply doesn't magically appear. So instead of affordability improving, competition actually increases. Prices stabilize or start to rise again. So lower rates don't directly help buyers if prices adjust upward with them. And that's how you get a market where monthly payments stay high even when rates fall. And this is the part that people don't like to talk about. Lower rates don't cause housing crashes. They prevent them. But if rates fall before prices reset, prices get locked in. Sellers stop capitulating. Buyers stop waiting. The market refreezes, just at higher price levels. That's great for existing homeowners, and it's great for sellers. But if you're waiting for prices to fall, lower rates can delay that indefinitely. And that's why affordability doesn't improve just because money gets cheaper. See, the real risk isn't Kevin Warsh. The real risk is perception. If markets believe the Fed is no longer fully independent, they demand higher returns. And that's how you get the worst possible outcome for housing. Mortgage rates don't drop, no increase in supply, prices won't fall, and buyers are stuck waiting forever. See, housing doesn't need cheaper money. It needs more homes. And without supply increases, lower rates mostly reshuffle who gets to buy a house. So here's the bottom line. Trump wants Kevin to make borrowing cheaper, and that could restart housing activity, but cheaper money doesn't really fix housing. It fixes liquidity, not affordability. So if Warsh becomes the Fed chair, don't just watch rate cuts. Watch bond yields, watch supply, and watch price behavior, because the next housing cycle won't be decided by buyers or sellers. It'll be decided by whether the Fed can lower rates without locking the market in place.